Nice to have you here. Welcome to the Farm Succession Planning Seminar. It's great to have you all here. And how about that lunch? Good. It's from Juliana's in the village in Shrewsbury, 14 North Main Street, Shrewsbury. Juliana's in the village is a farm-to-table restaurant. Everything they serve there is made from local produce, meats, cheeses. It's all local, York, Baltimore County, and they do an exceptional job. So I suggest you support them. They support the local farm community, and actually their food's quite good. So give it a try. Okay. Once again, I want to thank you all for taking time out of your busy schedule to join us today. Before we get started, some housekeeping items. The bathrooms out this door to the right for you, right? And then to the left. Okay. So if you have that need, please, feel free to help yourself. Also, there's coffee, water, snacks, whatever. Please help yourself throughout the afternoon. We want you to be relaxed and have a good time because we're going to learn a whole bunch of stuff today. I want to thank some people for their good work today and getting this going. First, my wife Joy, who's doing the filming, and Gina Cradaville. They both assisted Sarah in putting together the agenda and working on getting all the materials together for today. So thank you both very much. And we also have some insurance company underwriters here today. In case any of you would like to ask some insurance company underwriters questions. We have with us Julie Reese and Mary Ann Jones from Brother Mutual. Julie and Mary Ann. We have Dave Manifold from Westfield Insurance. And Josh Mussman and Jason Lamb from Donegal Mutual Insurance Company. There are insurance companies that specialize in agri-farm business, so we're glad you're here with us today. We're not going to do any actual presenting, but they'll be available to answer questions, and we appreciate the relationship with all these companies because it's important to have companies understand the farm business, and they all do a great job for us. And I won't give phone numbers out. Lesher, person, phone numbers, cell numbers. Don't say that. All right. Also, I'd like to acknowledge some folks for their good work in making this happen today. First off, the People's Bank. People's Bank for letting us use this room. People's Bank is, I guess, the only local bank left in York County. And so they are a big supporter of the York County community, and we really appreciate the relationship that we have with them. And to kind of wrap it up, when I was a much younger man, I went to Worley's auction to buy some People's Bank stock. I don't remember where else do you get People's Bank stock?
Yeah.
County, Worley's. It's a little country auction. Charlie Worley's quite Dutchy. And before the auction, he would give a talk to everybody about the People's Bank. He said, there's some pretty good folks here at the People's Bank. I've been dealing with them for a lot of years. They treat me good. I'm sure they'll treat you good too. So, and they have. They're a great community supporter. So, and also from the People's Bank is Brady Barnes. Brady worked with Sarah in putting the agenda together and coordinating all this. Thank you, Brady. And speaking of Sarah, my Sarah Brown, there she is. She was the coordinator and put a lot of work in putting together the agenda, the speakers, all that. Very proud of her, and thank you for all your good work, Sarah. And incidentally, she is our succession planner. Now, we have a lot of ground to cover today. It's going to be a lot of interesting stuff. So I think what we'd like to do is have to give the speaker their time to do their presentation. And then we can ask maybe one or two questions. And then at the end of the day, after all the speakers have had a chance to do the presentation, if we could ask them to come back up and then we can ask more questions, because some of them may be answered in another presenters talk. So But I've been doing business with farmers for nearly 35 years now. And just about all of them have a desire to want to pass along their farm or their work to the next generation. But very few of them have done little planning and preparation to ensure that that happens. And so, unless the actual preparation for planning is done, the chances of them actually having their intended result happen are pretty slim to none. So today we put together some experts in the various fields, and they're going to talk very specific. Now, they have limited time, so I'm sure they can talk for days, hours. But they're going to talk in their respective fields. They're experts. All these presenters have either lived on a farm, still live on a farm. They have a true interest in agriculture and farming. And so I believe that they're going to give you the knowledge that you need to make better decisions and hopefully to achieve your desired results. So we're going to start with Darlene Livingston. Darlene serves as the Executive Director of Pennsylvania Farm Link, a nonprofit organization dedicated to linking farmers to the future. She accomplishes this role by providing workshops for farmers with succession planning and beginning farmer topics, serving as a facilitator and administrator of the path of organic farming through the PFL website. She also provides private consultation to farmers concerning farm succession as well as beginning farming needs. And Darlene's understanding of the agriculture industry and passion for her work springs from 40-plus years of diversified livestock and crop farming background. Her goal is to assist beginning and well-established experienced farmers to take the next step while focusing on what's best interest for the farmer and the farm. So, Darlene, come on up. You want the podium to move that away?
No, it doesn't matter.
Okay. That makes sense?
That's fine.
Okay. Okay, here we go.
Well, thank you. I'd just like to welcome everybody here today. And this truly is a very important topic. And I'll just get started through my slides. If you have questions, like we said, we can hold those for afterwards. And the other thing is you can contact me later if you would like. First of all, I work with people from across the United States, and is in the organization called International Farm Transition Network. It also supplies me with many resources, and we just like to acknowledge them. John Baker out of the Iowa State University. He is a well-known attorney there, and he has great credentials and a long history there of doing good things for Iowa. Ag Transitions out of the University of Minnesota, the Virginia Department of Agriculture, and Keith Dickinson, who's now with Farm Credit East. First of all, according to 2005 survey of Pennsylvania farmers, 40% of the operators do not plan to fully retire from farming. And while that is not a problem as long as they do their planning anyway, out of that, 64% of the respondents had not identified a successor. Essentially, they had not taken that step to figure out who was going to take over their farm. And that is a problem because, as we well know, down the road that can create issues at transfer time or in their estate settlement. Why don't we plan? There's several reasons. It's too complicated. There's so many various things involved that we just don't like to deal with it. We are too busy. Farmers are always busy. There's always something to do, and most do not want to be inside working at something like that. And it does make us face our own mortality, as far as none of us are going to be here forever. So we do have to face that. And we're afraid to bring it up. Many times, either generation and both generations are afraid to bring up the subject to the other one for fear of what will happen, what they might think, and so silence continues. We don't understand each other's points of view. That many times is a big issue, and something that I'll delve into just a little more. Succession planning guarantees if you do the work for it, it will require a lot of work, but it is not, and it will not be comfortable. It does take a lot of time. It's not an overnight thing that's going to happen overnight. And communication is required. So that's part of the discomfort, is there's a lot of communication required between generations, and I want to say also with the professionals involved, that you need their assistance to complete the task. One thing I like to do is bring up some of the questions of each generation. One of the main questions that I find of some of the senior generations asking is, what will happen to the farm when I'm gone? And what if I need to live on it before then? What am I going to do, in other words, for retirement income or for the income it takes me in my senior years? I know of a tragic situation in Western PA where someone is no longer with us because they did not know what they were going to live on if they handed the farm over, but yet they were being pressured to do so. And the lady couldn't handle it, and she's no longer with us. So there are situations where communication would make it all a whole lot different. And positive communication, so we don't want to see that happen. We want the communication to take place. And do I need to treat all the family members the same? My answer to that is there's fair and there's equal. And I'm a full believer in doing it whichever way makes sense. It doesn't have to all be equal, but that's an individual situation that everyone has to decide on their own. Answer for the questions of the entering generation. Will I be an employee or slave labor? Which many, as we all know, farming's hard enough as it is. Will it fit my family's goals? Many times the next generation has different goals than the older generation does. It doesn't mean either set of goals is wrong. It just means they're a different generation and they both have different goals and priorities. Will I be able to make a living for my family? Will there be enough income for my family to make a living, plus still provide for that senior generation? And if so, what does it look like? Will something need to be expanded? What will happen? In a recent situation I was aware of, someone was offered to be given the farm and the equipment, but they needed to make a business decision. They didn't need to make just a decision on their feelings. They had to pencil out, even with a free farm, was it going to make enough income? There are expenses, as we all know, with every farm, and it still has to be a business decision at the end. One other thing I'd like to say here is I've run into some people recently, a couple young ladies. I never expected it at a luncheon. After a meeting I was at, I knew they were all involved in their farm operations, and they told us at lunchtime their husbands went home to the family farm. And on the outside it all looked great. There was management transition and everything else. There was nothing in writing for either family. And that was scary to me because those young ladies voiced their lack of security in that situation, and it was well-founded concern for that, and there definitely should have been something in writing, and I encouraged them to bring up the conversation and continue it because you still want to have those things. You have to have them in writing. The succession planning process, I'll just go through a couple small things here, and I'm sure everybody will delve more into it. It's just about a little bit about setting up goals. First of all, you need to determine your values. What is important for me? Answer that question. Look at, as far as a vision, what is my vision for my future? What does that look like to me? Mission. This will come into play as, those things will come into play with your mission for the farm. How will this farm take me there? And then you can utilize that to set your goals. What steps are necessary to create my future? That, I believe, should be answered by both generations separately and even by spouses separately. Spouses will look at things differently, and there's nothing wrong with that. Both generations should then work those things together and look at each other's answers to that and do it openly and not criticize the other for having different answers than themselves. And that can be the basis to start some of the communication that's so important in a succession planning. The goals should be put in writing. They end up being a memorandum of understanding as far as between the parties involved. They should be specific. They should state clearly what, how, and when, and provide deadlines. This is just helpful for you later on. Measurable. That way, when you see your progress, it'll feel good when you make that step of progress, and that happens with the deadlines as well. And rank by importance. And I should take the time to say that you do have a handout there of all the slide presentations. The other thing I wanted to say was, I believe by the time the afternoon's over, you'll be handed so much information, you'll be overwhelmed. So please just take it one step at a time, and know that, take it one step at a time and just move forward like that, and you will have things to review that will allow you to review your information you've gained today once you get home. Part of the farm succession planning process is to assess the farm viability. That's one thing I just said a little bit about before. Living arrangements and income needs. This is for both generations. The senior generation is still going to need income as well. As we know, the cost of living keeps increasing, and so everyone needs to work through these situations. Analysis of resources and environment include estate planning, look at the tax implications, and what-if scenarios. To me, that's a buy-sell agreement that helps you in case something happens. But like I said, the other professionals will get into the details. And the most important ingredient, I can't say this enough, goes back to the communication portion of it. We all have to communicate, and many of us don't like to. Farm business meeting. One thing I would like to say too is you have to separate family and business, and that's a little hard to do sometimes when it's a family operation. One of the big tips that I have received from some of the other states, they always encourage everyone to meet at somewhere other than the family table. The reason for that is at the family kitchen table, you will take on the family role. Everybody will take on the family role. If you meet in a different location, you're more likely to take on your business roles. And so that's an important thing to keep in mind. And I don't care if it's a table out in the shop somewhere, something can be set up anywhere. And people have also suggested even public venues, or like a church sometimes will let you use a room or something like that. But anyhow, just consider that when you're having a family meeting. Respect everyone's point of view. Everyone should be allowed to say what they want to say and bring up what they need to bring up. Probably most of all, they'll bring up their concerns. And that's important that you hear each other's concerns. And don't forget to make sound business decisions, not emotional decisions. It's very hard not to make emotional decisions when it comes to family and family farms, but they do need to be sound business decisions. Fair versus equal. Just like to include a little bit about this. Equal distribution, it doesn't really require communication. It can just be set up that way. It is the traditional method. It doesn't require a lot of thought. It is easy to explain. If I have 4 children and I divide it up equally, that's very easy to explain. It doesn't take a lot of work, but it may not be fair to all the heirs. That's why we would consider fair distribution. The key concept is that the compensation equals the contribution. This puts a value on sweat equity. It puts a value on the time and effort that the person may have put into the farm. If one child came home to the farm and there's 3 children, it puts a higher value on the work they did. And I have some information at the back. There's some fact sheets in there that'll go into give you a guideline that you might want to use and you might not to look at that. States like Minnesota and Iowa have put together formulas to figure those, to kind of give you a ballpark figure on what that might look like. A consideration would be when Junior came home to the farm, a second farm was purchased. How that farm increased in value would all be because that person came home to the farm. If that was the only one that came home, and if that was the decision that farm was purchased for, so there would be a greater value that particular person would have in that operation on that particular farm. Planning resources. These are just some things that I have at the back of the room, and you're each one welcome to take them with you. To me, like I said, I think the main thing you can take away is your valuable information that you have there in the folder from Keller-Brown, and also the other information we can provide for you to review once you get home. I have a green folder back there. It has the fact sheet from Minnesota about fair versus equal and quite a few other things in it that I found to be helpful and to be beneficial. Planning the future of your farm it's this book that's back there. You're welcome to take that. It has many valuable worksheets in it. Really good ones for income, and expense needs for the families. It does have areas to put your goals and your objectives in and put deadlines in. So I call this kind of a good desk reference for people. The one thing I will say, it is from the state of Virginia. They were kind enough to help me secure them. So do not pay attention to any tax information in this, okay? Obviously, you don't want to pay attention to any tax implications, but you do want to use it for the rest of the material that's in it. Ag Transitions is another one that is available. It is an online resource. It's from the University of Minnesota. You can go on there and use it to build a transition plan online. If you don't want to do that, there's also a workbook that goes with it, and this has the same thing in that they have online. And again, it's a valuable tool. If you have someone out of the area, they could go online and you could do the workbook, whatever. They do also offer professional reviews of the plans online, confidential professional reviews. And there's people from like the University of Nebraska, Minnesota that help with that I would truly trust to help because I have spoke with some of them. It also allows you to give other professionals access to your plan. Some of the people you might work with, whether it's your insurance person, your financial officer, or your attorney, you can also give them access to that. On our website, we try to provide links for other resources, valuable information, legal, business, various types of information there that you can have a direct link to. We also have an online database for entering farmers and landowners. That would only pertain if you didn't have someone in your family that you were thinking of transitioning to. We offer a facilitator program where we will be happy to meet with a farm family. The one thing I will say is we'll just encourage you and try to ask you questions to lead you down the path to your succession plan. We do not provide professional advice that you should seek from one of the other professionals that are here today. And develop a timeline and so on for your succession plan. The one thing I would say is one of the most important accomplishments for the future of the farm and possibly your family is to put together a succession plan, and it will be well worth your time. So, and like I said, these resources are back there. Please feel free to get them on the way out. I just didn't want you to have to juggle them while you were sitting here. So thank you. Are there any questions?
Okay, great. Thank you very much, Darlene. It seems like such a common sense, logical process to go through. All I can say from personal experiences, I wish I had done that. My dad would have done that. I think we can do a seminar on what not to do for successful succession, farm planning, because I lived it. It can be a mess. So, Darlene had a nice, I think, very logical thought process to go through, and perhaps if you have some other questions for her later on, she's going to be available. Now we're going to get into a little more detail, and our next speaker is Snyder from Barley, Snyder, LLP. And Alex will talk about the pros and cons of transferring farm assets, the legal entity, which is something that working farms should have to consider. Strategies for transferring property between generations and the estate, including inheritance taxes. Alex is a partner with Barley, Snyder, LLP. He practices in the area of estate and trust planning, administration, tax planning for individuals and business owners, and fiduciary litigation business law. He is active in the York County State Planning Council, the York County Farm and Natural Land Trust, Susquehanna Gateway Heritage Area, and the East Manchester Township Zoning Hearing Board. In addition, he works as an attorney. Alex and his father operated commercial grain and hay farming operations in East Manchester Township. His father's here with me today, Jeff Snyder. So, Alex, you're up next. Come on up. paying attention.
I'm going to ask, off to a rough start already here.
Computer Pro, sorry.
Sorry about that.
All right, well, thank you very much for taking time out of your afternoon to be here today. And I'm an attorney and try to focus on estate planning issues that might come up if you're thinking about transferring your farm to the next generation. I have a lot of material in my slides here, and my hope is that I'll try to get through this before I put everybody to sleep today. But there's more information in there that will hopefully you can take away. And if you review it later and you have questions, certainly feel free to get in touch with any of us. My goal today, and really the goal in figuring out how to transfer your farm to the next generation, there are a lot of things that you need to think about. And clients come in and ask about their overall estate plan and transferring their farm in general. Some of my goals are to accomplish the transfer of the farm between generations, the people that want to be involved in the farm, without causing a fight or jealousy with the next generation. If you have a plan that all it ends up doing is your family gets along just fine, but if you put a plan in place to transfer it and everyone hates each other afterward, then I failed in my job, and frankly the older generation has failed. So that's a very important consideration. Next, ensuring that the farm has a continuation plan. Much like my dad would probably say about our own farm, he's the brains behind the operation, and from the last presentation, I'm the slave labor. So, continuation plan, you need to make sure that the next generation has the capability to know how to run the business. That's a very important thing. The farm needs to make money. In today's world where you have a lot of debt related to your farm, or at least most farms do, it's very important to understand those concepts. Minimizing transfer tax and debt taxes, or transfer costs and debt taxes. Now, a lot of clients come in and they say to me, what can I do to avoid paying death taxes, meaning estate tax or inheritance tax? Well, there's a lot of stuff you can do to avoid death taxes, but in my opinion, the most important thing is figuring out what plan is best for your particular family. Saving taxes should always be secondary to making sure that you have enough to live on in your retirement. You're not giving everything away just to be destitute, because that can you can end up saving death taxes. It's only going to benefit your family. It doesn't do you any good if you don't have enough money to live off of. Liability protection for the business. Now, some of our insurance experts are going to be talking about the insurance side. From a legal standpoint, talk a little bit about business entities, putting your farm that you own in your own name into a business entity. Now, there are pros and cons to that. I don't think that's right for every situation, but I'll go over the benefits and the downsides. And just to stress, there's no magical solution to transferring your farm. There's no one-size-fits-all. What we have is a toolbox, some plans that will help you minimize taxes on the transfer and carry out your goals. But really, every farm is different. No farm is the same. There are different levels of debt, different personalities, and that's very important to consider. So we don't try to shoehorn everything into one type of plan. We have to look at, there are a lot of different considerations. Now, I'm going to break up my presentation into lifetime transfers that take effect at death, and then I'm going to talk about hidden benefits in the tax law. Now, the breakdown between lifetime transfers and transfers at death, I think, is important, because for a lot of families, you're in a position to transfer your farm during your life, and there are a couple of avenues for doing that, including sales, gifting, and then entity formation, which I'll talk about. Other families, if you want to maintain control, you want to hold on until your death, that's certainly understandable and I think appropriate in a lot of cases. So we'll talk a little bit about some options for transferring your farm at your death through your will in a manner that will maybe equalize things amongst your children, including those that want to be involved in the farm and those that don't want to be involved. And then the hidden benefits in the tax law are just, I think they're important because understanding those benefits and where they're at can factor into how you structure your plan. Now, our accountant, Ron Miller from RKL, is going to be covering a lot of the tax issues. But just to talk about your death taxes. Now, death taxes is in when you transfer property at death, your estate is taxed both by Pennsylvania and potentially by the federal government. Now, Pennsylvania taxes transfers based on the relationship between the decedent, the person who died, and the family, and that depends on how close you are. Now, transfers to children at 4.5%. There's no Pennsylvania gift tax, meaning that Pennsylvania doesn't have a separate tax on gifts. But what Pennsylvania does do is say that if you try to transfer property, there's a 1-year cutoff before you die. You go back a year, and then any transfers you made come back into your estate, and they're subject to inheritance tax. Now, that's just a bright line test, or a bright line that they've drawn at a year. It doesn't necessarily make sense, but what they're getting at is they don't want people on their deathbeds to transfer out all their property and avoid tax. I guess people were trying to do that before when they came up with that rule. Federal gift tax, now if you gift property during life, you have an annual gift tax exclusion, which factors into, again, some of the plans I'm going to talk about. You also have a unified, above and beyond the annual gift tax exclusion, you have a lifetime amount that you can transfer tax-free. Right now, that's about $5.25 million. It's $5 million indexed for inflation, so it's about $5.25 million per person. Married individuals have twice that. Gifts in excess of those amounts are taxed at 45%. Now, estate tax and the federal estate tax and the gift tax work together. So when you die, on your federal estate tax return, you look at all the gifts you made during your life and how much of your $5.25 million or whatever the credit is that at that time you used up, and you apply what's ever left in your estate. If you're below the threshold, you don't owe any tax, and if you're above the threshold, then it's taxed at 45%, which is a pretty big hit. And notably, that includes life insurance owned by the decedent, and there are strategies to avoid, if you have a lot of life insurance, to get around that. Now, talking about lifetime transfers, meaning that a plan you put into effect while you're living. Just some things to think about, and reasons why a lifetime transfer may be something to consider if you're thinking about transferring your farm to your children or to your grandchildren. One of the benefits, it allows you to sort out family issues while the older generation's still alive, meaning while you're there, it's your plan, it's your farm, you have the ability to control what happens and to dictate what's going to be done. If you put that in effect during your life, you're there to more or less see it through. So that's, in my mind, an important reason to think about transferring before you pass away. Avoid trapping assets in your estate. Now, from a death tax standpoint, the more that you have when you pass away, the more potential tax liability you have. So, and like I said, Pennsylvania doesn't have a gift tax, so if you start transferring your assets out over time, that's a strategy for reducing your tax bill. Complete the transfer while minimizing or avoiding taxes. Like I said, if you can get the assets out of your estate, if you're in a position to do that, you can save some taxes doing that. No other considerations. Who will retain control? There are a lot of strategies that you can put into place to transfer the value of your farm and your farm assets without giving up control, and that's very important. Again, if you want to make sure that you're still running the show until you're gone, there are certainly ways to do that. And then who gets the income? The worst case scenario is, again, you look at your estate plan with the goal of just minimizing your tax, driving it down as much as possible. You don't think about it from an income scenario. Who's going to get the income? Because if you give away the farm completely, when it comes around to divvying up the income goes to the owner. You don't own the farm, you don't get the income. So that's something to think about, probably the primary consideration if you're thinking about a lifetime transfer. Now, how it's done. You can sell your farm to the next generation. You have to establish a value to do that. That's a benefit because, again, if your farm is your retirement, you're getting your retirement out. Now, I'm not going to talk a lot about financing, but one of the difficulties in the younger generation being able to buy a farm is getting financing. one of the things you can do is finance it yourself. And of course, then you're extracting income over time from the transfer to fund your own retirement. Now, Ron's going to talk about that in a little bit more detail. Bargain sales are a part gift, part sale. So what you can do is say, well, the farm is worth this amount, but I want to give the next generation a little bit of a leg up. So I'm going to gift this amount, and the rest is they're going to have to pay for and earn it, or they're going to pay for out of the farm income. Gifting, again, if you're in the position that you don't need the income from the farm, you can look at just gifting it over a period of time, and that's a strategy in families that's often effective. And then entity formation plus gifting is something I'll talk about with some examples. In other words, putting your farm in a business entity and then gifting interest in that entity out to your family over an extended period of time. That's a good strategy from several standpoints, saving the cost and also just having an opportunity to divvy it out over a period of time while you still maintain control. Like I said, with sales, the keys are determining the value. You'll have to get an appraisal to somehow come up with the value, and then the next key is the financing. How's it going to be financed? Will your children be able to get financing when they don't maybe have a lot of income if they're working on the farm? Will a bank really want to do it, or are you in the position where you'll provide finance for your family members to buy it out? Now, there are benefits to doing that. It certainly helps your family out. Now, the downside, of course, is what happens if they default? Are you in the position that if you don't think they can make the payments, how tough are you going to be on them? That's stuff to think about in advance. Bargain sales, like I mentioned, part is gifted and a part is a sale, so the same considerations. There you have to think about, again, putting a value on the farm and then determining what portion you're just going to gift outright without making your children or grandchildren buy it. Now, gifting considerations, I mentioned before, against federal gift tax, you can gift so much per year per person. So if I wanted to, if I was a billionaire, I could gift $14,000 to every person in this room every year, and that would be just fine. You would still be within your annual gift tax exclusion. That's a concept that comes into play when you're thinking about transitioning your farm. Gift splitting with your spouse. Now, again, if I have $1 billion in my name and my wife has zero, you can still make gifts and they'll be treated as split, so you can make larger gifts than you can do on your own. But how do you gift farmland or farm assets? Now, farmland and farm assets, land in particular, tend to be in large chunks. It's a large asset. How do you gift a portion of a farm that's worth $600,000, $700,000, $800,000? That's where entities come into play. We'll talk about it a little bit here. Now, gifting beyond your annual gift tax exclusion, each person can gift so much during lifetime, and currently that's $5,250,000 per person. Now, if you're married, that's twice that amount. You can gift that amount, and you won't owe any federal estate tax. You won't owe any gift tax. Once you get beyond that, then you owe tax at 45%. Now, business entities is, again, they're not a magical solution to every farm. A lot of farms, a traditional farm, the parents own the farmland and the assets in their own name. They probably own the farmland jointly. The husband and wife own it, so that the death of the first spouse, the farmland would pass automatically to the survivor. Now, an entity is a little bit different. You're actually transitioning ownership over to a corporation, partnership, an LLC, some other type of business entity. Now, fortunately, under Pennsylvania law, there's no transfer tax that would apply to those transfers. So no, there's no realty transfer tax. If you're transferring it in general, realty transfer tax applies at the rate of 2%. It's 2% of the overall value of the property. So that can be pretty steep, and that can be a reason not to do a transfer otherwise. That's a lot of cash that someone has to come up to pay the government. Now, fortunately, again, there's no transfer tax for transferring your property into an entity like that. Something else to think about is choosing the right form of entity. Again, I'll talk about the different types here in a minute, but it's very important to think about. There are some types of entities that are very easy to form, and they're good for managing your operation, such as LLCs. There are other entities that are good for owning farmland. and those are limited partnerships in general, possibly trusts. So now, if you transfer, the way it works is if you're going to create an entity, you would transfer your farm land or your farm assets over into the entity, and you would receive back stock or partnership interest or some other interest in the entity, and then that's what you own afterwards. And in order for an entity to work for your farm, it's important that, so if you set up an LLC, if someone comes into my office, we set up a lot of LLCs for different businesses, and I always tell people, you can have an LLC, but if you're not running your business through that LLC and you're not following the right formalities, like keeping separate accounts, keeping books, and having an agreement that governs everything, then it doesn't really do you that much good. You have to make sure that you follow the formalities, and that's a downside to setting up an entity. Now, I mentioned before that there are pros and cons of putting your farm or your farm assets in a business entity. One of the key benefits is liability protection. What that means is if someone would sue you if there's an accident or something else, and I know that's increasingly a problem the busier the roads get around York County. Last year we were moving a load of hay down, and cars always, if you go to turn left, you can't see them turning, and a lady with 2 little kids in the back came running up beside our tractor. The tractor went up over the side. Fortunately, nobody was hurt, but that's how quick things can happen. Now, liability protection, if you're in an accident like that, and somebody would sue you, they can only reach whatever's in the business entity. So it's a way to kind of insulate your liability. Now, I mentioned the other part of that's insurance coverage and making sure you have your insurance protection in place as well. But it's a way to really insulate your assets so that your exposure is only limited to what's in the business entity. Now, second one, separating ownership from control. With a business entity, the parents can still maintain control of the business in certain circumstances while transferring the value out of their estate for tax purposes. And that's an important concept to think about. So if you want to be the one calling the shots, but you're also in a position where you want to transfer the value of the farm onto the next generation, that's something you can do with an entity. Now, when you do valuation discounts for transfers, if you're transferring interest in an entity versus transferring just a regular asset, now say you transfer 2% of a business entity per year to each of your children. Having a 2% interest in a farm business where you don't have control, you can actually do that at a discount because there are valuation discounts applied by folks that say, well, it's not as good as owning the whole thing because you don't have control over the operation. So what you can do is get more assets out of your estate for less money. So that's an important thing to think about. Again, no transfer tax based on the current rules, so you can put assets into an entity without transfer tax. Another benefit, again, is providing for joint ownership of your farm or your farm asset. So you can transfer ownership to the next generation. You can still own it jointly with your children, but you can still maintain control. Now, costs. There are downsides to putting your business in an entity as well. There are transaction costs. So you have to form an entity. You have to come up with an agreement that governs the relationship, and there are additional accounting costs beyond if you own the assets yourself. Another cost is who gets the income. Now, there are different rules that apply to entities than apply when you own things individually. And Ron, the accountant, will talk about that a little bit more. Now, the inheritance tax exemption, which I'm going to cover later, there's an issue with that right now as far as transferring property in an entity to the next generation. It's not clear whether the exemption applies, so we'll talk about that in just a minute. Now, entity types. I'm just covering the basics here, but limited liability companies are a very simple, cheap way to set up a business entity in Pennsylvania. What you need is an operating agreement that governs the relationship between whoever are going to be the owners of the property, and that says who manages it, what happens if somebody wants to sell out, what happens if somebody dies. Those are things that are covered in the operating agreement, very important to have. They're taxed like a partnership, meaning that everything passes through. There's no tax applied at the level of the LLC. There's only one level of tax when it passes through to the individual. Now, they're good for operating your farm business, but not necessarily owning farm assets. Trusts are, an entity we use a lot in estate planning. You put your property, you deed your property over to a trust, to the trustee of a trust, and then the trustee governs that. Now, they're not the best, in my opinion, avenue for having an operating farm. They're sometimes a good avenue if you have younger children who aren't necessarily ready to take over, so you can name a trustee to control things until they're ready. That will maybe terminate when the kids are in their 30s, the trust goes away, then they own it outright. So it's a way to kind of keep control of things a while longer. Again, you need a trust agreement, and most importantly, you need to choose a trustee. Now, corporations, we're typically talking about subchapter S corporations, which are they're pass-through entities, a lot like partnerships. Now, a C corporation is the other type. That's like Walmart and things like that, or companies like that, where they're taxed at two levels. An S corporation is not taxed at the corporate level, with a few small exceptions. Everything passes through to the shareholders. It's more difficult to set up an S corporation than an LLC, but you can have voting and non-voting stock, and that's important, again, if you want to separate ownership from control. The parents can set up an S corporation that has voting and non-voting stock. They can hang on to the voting stock, and they can transfer the non-voting stock so that their children have a lot of the value, but the parents still have control. Now, income is going to be allocated based on stock ownership. So if you have 30-70 ownership of an S corporation, the income gets allocated 30% to the 30% owner, 70% to the 70% owner, and you can't get around that. Now, limited partnerships I'll talk about in a little bit more detail. There's something we use a lot in the context of estate planning. In a limited partnership, there are limited partners that own a majority of the value of whatever properties in the partnership, and they have protection against liability for their share. In other words, if somebody sues a limited partnership, they can't get outside of the partnership to your other assets. That's different from a general partnership where you just have two people getting together and owning things jointly, and there isn't liability protection in that case. Now, with a limited partnership, the limited partners own most of the value. A general partner owns maybe 1% to 2% or some figure that governs the operations of the entity. So the general partner controls things. The limited partners have most of the value. And again, that gets back to the concept of separating ownership from control. The parents can control the general partner, and in other words, control the operation and make the decisions, while passing on the limited partnership interest to the children and therefore most of the value. So that's a key component there if you want to maintain control of the operation but get value out of your estate for tax purposes. Now, just have a real quick example. So the parents, Jim and Diane, they own a grain farm consisting of farm equipment, land, and grain held in storage. 2 children are involved in the operation, and they're paid as employees. So Jim and Diane are ready to transfer the farm, or at least transfer it over a period of time. So they take their farm and their farm assets, and they deed the farm over into a limited partnership in exchange for partnership interests. Now, the limited partnership interests are about 99% of the value of what's transferred, and the general partner owns about 1%, and the general partner is a limited liability company. Now, I mentioned how things are transferred over and how it's broken down. 99% is with the limited partner, 1% is with the general partner. Now, there's a partnership agreement that governs the terms of the relationship between the partners. So what happens if somebody dies? What happens if somebody just wants to sell? What you want to do is restrict the ability of third parties to get involved. Maybe you don't want your sons or daughter-in-laws to get involved in running or owning the farm. So you can have restrictions on the ability to transfer partnership interests outside of the group. So then going forward, Jim and Diane gift limited partnership interests. In other words, each year they're going to gift some small percentage of limited partnership interest to their children to get the value out of their estate. The goal is when they pass away, most of the value of the farm is going to be transferred to the next generation, but it's going to be done over a period of time using their annual gift tax exclusions. And again, there are discounts for those transfers based on lack of marketability and lack of control. So what they're able to do then is to transfer the value of the farmland out over a long period of time without having any estate tax consequences when they pass away if they get it all transferred out. And they're also able to get so say the farm's worth $800 or $1 million, they can get discounts of 25, 30% on those transfers just because their children don't have control. Now, importantly, they can keep control of the general partner and the operation until they pass away, so they can be the decision makers, or if they're ready down the road, they can do the transfer then. Now, transfers at death, a little bit of a different story. I mentioned before some of the considerations here, why you might want to transfer your property at death. Maybe you're just not ready to do the transfer. Maybe you want to make sure that you have enough income in your retirement. Maybe it's just that there's nobody there ready to take over. So transfers at death certainly make sense for a lot of people, and I'm just going to cover briefly how it's done. Now, if you own property jointly, a lot of times people come in and say, well, can I put my son or daughter on as a joint owner? You sure can. If you own property with rights of survivorship on the death of the first person, the property passes automatically to the other joint owner. And as long as you know what the repercussions are and how that's done, there's certainly nothing wrong with that as long as you thought it through. Property owned that you don't own jointly at the time of your death will pass through what's called the probate process. And what that means is you have to go to the courthouse, or your family has to go to the courthouse and get the legal authority to make transfers. And then the Register of Wills will issue what's called letters testamentary, and they give your executor or your other family member the ability to, or the power to do the transfers. Now, if you have a will, that governs how your probate property is transferred. If you don't have a will, a lot of people ask, well, if I don't have a will, does that mean the state gets everything if I die without a will? Well, no. Actually, what happens is there's a law that says what happens with your property if you don't have a will. And what it says is it goes to your closest relatives as defined under the law. So that means if you're married, typically your spouse gets the entire thing. If your spouse isn't living, then it goes to your children and kind of on out till you get about three degrees of cousins out, and then it goes to the state. So as long as you die with some relatives, most likely that's who's going to get your property if you don't have a will. Now, a very basic will that for a non-farmer that we would write, if someone came in and said, I want the very basic, bare bones will, what that would say is on the death of the first, now husband and wife situation, on the death of the husband or the wife, all the property would pass to the survivor. On the death of the survivor, then everything would pass to the children equally or in equal portions. That would be an equal division. But the problem in the situation of a farmer is that estates aren't usually liquid. They're made up of a lot of large assets in large chunks. And how do you divvy that up when you pass away, particularly if you have some children who are interested in the farm and some children who aren't? One strategy we use a lot of times is to incorporate an option into the will. And an option is by giving somebody an option, you're giving them the right to buy certain property on certain terms. So in a situation where you have a family with maybe one of the children is interested in the farm, but the other children or child is not interested in the farm, we would include in your will an option for one of the children to be able to buy the farm real estate or the farm business interests on certain terms. Now, the purchase price could either be the fair market value, so we could say John wants to be interested in the farm, Laura doesn't want to be interested in the farm, so we're going to give John an option to buy the farm out of the estate based on its fair market value as determined by an appraisal. So then when you pass away, if John wants to exercise his option, he can go out, get an appraisal done of the farm, and then he can effectively buy out his sister's interest from the estate. The result then is that that Laura, the non-farm child, is going to get money out of the estate, and John will get the asset. Now, you can make that a little bit easier on John from a financing standpoint by providing, and the way I usually write them is by providing that John can pay for the buyout over 10 years, maybe a 10-year installment. Now, that, of course, isn't ideal for Laura, but that might be the best option for everybody so that John can afford to buy it, and so that Laura she still gets her half of the farm assets, but just paid out over time. That's an important strategy that we use from time to time. Now, the pros of waiting till death, like I said, you can maintain control while you're still around. You can implement you can still have a transition plan, even though you're not carrying it out until you pass away, and that's important, I think, in either case. A lot of times with debt, you can pay down debt so that when you do transfer the farm at your death, your children aren't saddled with all that debt. Now, the downsides to waiting to your death to transfer your farm or your farm assets is you're going to have the most exposure to death taxes. Like I said, the more that's in your estate when you pass away, the more potential exposure that you have. If you don't have a plan and you pass away, or if you just have a very simple will, like I mentioned before, and there's not enough liquidity in your estate, it could mean that the farm's broken up, and that's not a very good outcome either. So that's another reason to think about it. Even if you're going to wait till your death, think about the plan, liquidity issues, what else is going to be in your estate to equalize things. Is there going to be enough in there to keep the farm going until your children figure out what to do? Because again, you don't want to have the farmland to be split up and sold off and all your assets. That doesn't really do anybody any good either. Now, hidden benefits in the tax law. I'm going to go through these pretty quickly. Why am I covering this? Because Pennsylvania, 2012 was a pretty good year for farmers in Pennsylvania in terms of some of the changes they made to the law. They passed an exemption from inheritance tax, that's the state tax, for certain transfers, for certain farm family transfers. So it'll be interesting. I'll go over to show you how they define a farm family. Now, there are special use valuations, so that if there's farmland or farm assets in an estate, they don't get valued at their highest and best use when you're determining what the tax liability. They're valued on the basis of what their use is, kind of like the clean and green for your property taxes. Valuation discounts for farmland. There's a word missing, and that's farmland preservation. So if you're worried about the ability of the next generation to pay taxes, you don't want to see your farm developed, you put it under conservation easement, you can get a significant tax discount for doing that and sort of accomplish a lot of things at the same time. Installment payment of taxes. There are options both for the state and federal returns that allow you to pay off your tax liability over a period of time, so that if you pass away and you do have a significant tax bill, your children aren't going to be saddled with that bill all in the year that you die. They can pay it off over a period of time. Now, that's a very big big benefit, and it's just something to be aware about. Now, why are these concepts important? Why am I covering them? A lot of times, Congress, when they want to get, I guess, different tax bills passed through, they say, we want to get these tax benefits through because we want to benefit the farmer, because if you don't have these tax benefits, farmers are going to have to sell their farms off and break them up. Now, if you understand these principles, that should never happen. It happens very, very, very rarely. It shouldn't happen to you if you know how to apply these principles. And it's also the new exemption from inheritance tax requires some planning ahead to make sure that you qualify it. It can really significantly reduce your tax bill, but there are some slight changes either way that would bring you in the exemption or outside of the exemption. Now, I mentioned before, federal estate tax rarely applies to farmers because of the benefits that are there and the valuation discounts. So this is from 2011, but in terms of farm transfers, only 98.3% didn't have to file a federal estate tax return or pay any tax. 1.2% had to file a tax return but not pay tax, and only 0.5% had to actually pay any federal estate tax. So it's a very small portion of farm families that have to worry about federal estate tax. Now, the new exemption in 2012 from inheritance tax for transfers of farms within your family. That applies to, there are three principal requirements. It has to be transferred to a qualified family member. Now, that's a pretty broad, it doesn't just mean your children, it means your cousins, nieces and nephews. It's really a pretty broad definition. The gross income has to be $2,000 a year or more. So they're cutting out, hobby farms and things like that where it's not a real working farm. Most working farms would qualify. The farm has to be devoted to the business of agriculture for 7 years after the transfer. That's very important, and it remains to be seen how strict the state's going to be in applying that. But there's a certification that has to be filed every year after your death if your children or your spouse are claiming the exemption to say that the farm is still devoted to the business of agriculture. Of course, the term devoted to the business of agriculture has a specific meaning under the law, and I'll just cover that briefly. So just to compare, before the 2012 change, the farm will be valued at its fair market value or perhaps its special use valuation and taxed at the rate of 4.5%. After 2012, transfers of property devoted to the business of agriculture within the family are exempt from Pennsylvania inheritance tax. That's a very big and very important change for farmers. Now, some issues with the exemption. So a lot of people in York County, as you know, own farmland, but they don't farm it. They rent it out to somebody else, to a big operator. There are a number of them around. Unfortunately, if you, under the law, the term devoted to the business of agriculture means your children are actually farming. It doesn't mean they're renting it out to somebody else down the road and they just own it. That doesn't qualify. So that's an important thing to think about. Now, what about farming for the half? There isn't a whole lot of law out there on, so if your children say, well, I'm not going to get $1 rent per acre, I'm going to farm it for the half. That's a little bit better from a tax standpoint because they're still going to be involved in the management, but it remains to be seen how the state will look at that. Now, transfers via entities, so if you put your farm in a limited partnership like I discussed before, an LLC, they don't presently qualify, or at least the state hasn't opined on that. I'm almost sure that will be worked out fairly soon so that transfers via entities will still qualify, but still something to think about right now. Certain farm businesses don't qualify. Most working farms, traditional farms we think about are going to qualify. Something like a game farm it will not qualify. That's not considered to be a farm business in Pennsylvania. Now again, I mentioned, so if you pass away, you own a farm, your children are going to farm it, you're going to qualify for the exemption. You have to certify to the state of Pennsylvania for 7 years that it continues to be devoted to the business of agriculture. And if you don't do that, so if your children make it 5 years and then they decide to sell out, they're going to have to pay back. They're going to have to pay the tax that they would have owed initially plus interest. So just something to, if you decide to claim the exemption or your family decides to claim the exemption, it's something to pay very close attention to make sure that someone's really going to keep it in operation for 7 years, or they can really end up having a big tax bill when they decide to sell. And I mentioned before, it's a new law. It remains to be seen how Pennsylvania is going to apply it. My experience with dealing with the Department of Revenue is they don't take issue with a lot of stuff. I don't think they have the manpower. But that's not to say you don't want to look at these requirements and make sure. If you're not in the position when you pass away to make sure that your farm is going to be continued on to the next generation for over 7 years, you should think about not claiming the exemption, because it's just, it could present more, do more harm than I guess it's worth. Now, real quickly, in addition to the new exemption, and whether or not that applies, there are other benefits that Pennsylvania inheritance tax that will apply under the law. There's special use valuation, which is similar. So properties in clean and green, rather than getting taxed at maybe its development value, it'll get taxed at its farm value. If you put your farm under conservation easement, you get a 50% reduction in value, and the first two provisions can be used together. So you can really knock the value down in your estate by virtue of those two exemptions. And again, they apply regardless of whether or not the overall exemption I described previously would apply. Now, tax can be paid in 20 quarterly installments, so that's a way for your family, if they don't have the liquidity in the first years, to pay off the tax bill over time. Similar rules apply under the federal estate tax regime. Again, if your property is under conservation easement, you can get a 40% discount up to $500,000 on the tax return. There's also a special use valuation for farms, which again taxes at its use and not its highest and best use, which would probably be development in a lot of cases. And then there's also the ability to pay tax in installments, provided that the farm is 35% or more of the value of the estate. And that's the case with most working farms. You can pay up to 10 installments, and your family can delay paying for 10 years. Key points to remember as I wrap up here is have a discussion with your family ahead of time on the transition plan. Whether you're going to do that during your life or whether you're going to do that at death, have a discussion. Think about your own needs before you worry about saving death taxes. Again, there are a lot of strategies we can put in place just purely to save taxes, but you really have to think about what are your needs going to be in retirement? Is there going to be enough income there to sustain you? That's more important, in my opinion, than saving taxes down the road for your children. I mean, it's tough for them, but it's something that needs to be considered. Now, avoid surprises. Know what your tax liability is going to be when you die, and just be prepared for that. Know if you don't have liquidity, there are ways around that, or there are ways to come up with liquidity. And think about the risks and the costs before you go down any path. I mean, the last thing you want to do is go to someone and they tell you, yeah, we have this great solution that's going to work out. You really have to know what the downside. Every solution, in my opinion, has a downside and has an upside, and you really have to understand both before you go down any path. So that's all that I have, and if anybody has any questions, I'm happy to answer them now or at the end. And thank you for your patience. I know we went through a lot of material, and I don't see anybody asleep yet. So.
Next up is Ron Miller from RKL LLP, and Ron's going to discuss accounting issues with you, such as family dynamics, cash flow challenges, and depreciation rules, as well as has several case notes with graphic case studies, right? It's, to tell you, it's the real world. Ron is a partner with RKL Tax Services. He specializes in advertising individually and family-owned businesses, and his particular expertise is managing tax-deferred exchanges. He applies his skills in wealth management to benefit individuals and entrepreneurs and coordinating with business development and succession. He's an accredited personal financial specialist, has developed expertise in wealth transition planning, helping individuals realize millions of dollars in tax savings during the transfer of assets from one generation to the next. And he's skilled at evaluating business performance and structuring business acquisitions. He has an incredible active membership in community service, and we're just delighted to have you here, Ron. So come on up and educate us.
Thank you, Jeff. Boy, my mom writes a great introduction. I really I'm very pleased to be here with you today. When Sarah asked me to come today, it's a busy time because I'm involved in tax, but I'm delighted to be here. She said, just tell people everything you know. She says, you have a half an hour to do it. I thought, I can't stretch this out to a half an hour. But I'm going to do my best. First of all, let me try to get some credibility because, first of all, I'm from Livingston County, so I don't want you all thinking I'm just a suit-wearing carpetbagger. My grandfather had a farm. My dad grew up on that farm with his 8 brothers and 1 sister, so there were 10 of them. I really started working with farms through my dad because he had a great reputation. I've always had a great appreciation for the challenges and the difficulties of farming. I've been a CPA for 41 years, and I currently work with at least 150 farm families. And so over those 41 years, I've handled probably 6,000 farm tax returns in addition to the other things that I do. The farm work probably constitutes maybe 15% of what I do. Since I've been here for 41 years, we've done a lot of things with now transferring some farms to the 3rd generation that we've worked with. So I'm very happy to be here, and I'm going to get started with things. And the technology is working great, so we're in good shape. I'm very pleased that we had the introduction here by Darlene on the family dynamics and by Alex. I want to address, I'm not going to spend a lot of time on the family dynamics because I'm not a psychologist. The cash flow challenges I want to talk about, you're all very familiar with those, but I want to relate those challenges that you have with the farm in relation to the challenges that we have in the general market that we're looking at. We'll touch on depreciation rules and capital gains taxes, but I know those are probably 2 of the most boring things you can ever talk about. So we'll sort of go through those, talk about cost of debt service, I want to follow up with what Alex said about the estate tax and the Pennsylvania inheritance taxes. Not really in the nuts and bolts sort of thing, but with some examples that I've brought along today from projects that I've worked on in the last, I've got 3 projects along that I've worked on in the last year, and I've got more in case we need more to fill out the time. I would welcome any, as I'm going along, I can handle questions as we go, so if you've got a question, please stop me. Actually, I should have awards for the first spelling error and another award for the first question, so please, please help me out here. One of the things Alex talked about was sale at fair market value. Well, we know that's kind of challenging. One of the reasons is that it takes an awful lot of cash, an awful lot of capital investment to go into farming. And the return is seldom immediate on that cash, on that capital investment. In fact, now I'm sorry, I learned at lunch that I've used inflated values here. I used Lancaster County values, but farm can sell for, over in Lancaster County at the auction, at farm auctions, a working farm is going for about $15,000 an acre. Our rents have gone up in the past, but they're now about $350 an acre. I understand that things are a little different over here in York County, that I can take the first figure and divide it in half, and I can also take the second figure and divide it in half. So I'm lucky because that if we divide both of those by half, we still get to the same kind of capitalization ratio, that farms sell at about 40 times earnings. Well, the stock market, which everybody's concerned about today, that gets up around 15 to 18 times earnings, and everybody starts to panic that there's a bubble and it's going to burst. We haven't seen that with farms, but that's one of the reasons at $350 an acre. Good luck trying to pay off a $15,000 an acre farm, or at $180 an acre. Good luck trying to pay off a $7,500 an acre farm. It just can't happen. Farm incomes are insufficient to repay the cost of capital for farming. The challenges, and we've talked about some of these before, is that the retiring or selling generation has a need for cash flow and to cover their living expenses and potentially increasing medical costs. And again, some of the folks that I've spoken with, these increasing medical costs have done a lot for longevity that 2 generations ago we didn't see. Then the other issue is how much debt service can the purchasing family afford? What kind of opportunities do we have? Can cash be generated with agricultural easements? We've been able to very successfully use those in some instances. Of course, these depend on public funding, and those sources are not as plentiful as they used to be. So we've got the restrictive capital there. The other fortunate thing is that we have the estate exclusion now permanently set after January 3rd at $5 million plus adjustments for inflation and affordability, so that the married couple can have $10 million. So that makes things a whole lot easier in terms of estate and gift tax planning. Provision in the estate tax provides a step-up in basis to fair market value with assets that you have in your estate. So the neat thing about that is if you can hold on to something, if you hold on to something when you pass away, and someone is going to inherit it from you in your family, they get to start the depreciation all over again at the fair market value without ever paying the capital gains tax. So that's a sweet little gimme in the tax rule, but it also has some inherent disadvantages. That pitfall is that I'm going to go to the second pitfall first and then come back to the first one, is that by taking advantage of the estate exclusions may lead the proposed seller of the property to hold on to it too long. And by that I mean that the second generation may not have had a chance then to develop their own equity or grow the farming operation, and you'd end up then skipping to the third generation. The other pitfall is that any lending institution, in order to improve the cash flow of the farm by putting on some livestock operations, or by expanding the farm, or by buying new equipment, whatever that takes, banks are going to be looking, and we'll hear from the banks later on, but they're generally looking at the underlying value of the farm. So if you still own the farm, but someone else is actually farming it, the person who's actually farming it doesn't have the capital or the collateral to support the farm loan. So the landlord may have to guarantee the debt, which is exactly why you wanted to get out of the farming to begin with. So that's a potential pitfall. Not to reiterate, but January 3rd, Congress finally got around to settling the uncertainty about estate taxes, and we now have something permanent until they decide to change it again. But that's about $5.25 million, as Alex had explained, and that really, as he explained, there's only 0.2% of the farm estates that are now taxable. Annual exclusion is $14,000 per donee, so husband and wife can give $28,000 to any one individual. If you're making that jointly, that bumps it up to $56,000 to a married couple. But that isn't the end of things. After you do the $14,000, all you do is start using up some of that lifetime $5.25 million exclusion. And all that means is that you can't use it later when you need it for the estate. Now let's talk briefly about capital gains taxes, because this is something that many of my clients get tripped up on. Farm equipment and special purpose agricultural buildings, which of course have the 10-year depreciation instead of the 20-year, milk houses, tobacco buildings, livestock operations, silos. When they are sold, the tax on those is pulling back the depreciation that you've taken over the years. And that's taxed at a 25% level, not the favorable rates we have at capital gains. The other drawback to those assets are called Section 1245 and 1250 assets. That you don't need to know, but even if it's on an installment basis, that depreciation recapture has to be paid first. So if you don't check with your accountant first, you can run into the situation where you have sold something on the installment basis, maybe over 5 or 10 years, and all of a sudden you've got an upfront recapture of the tax at 25% and have not received the cash to pay for it. So that can be a hazard. So just as a quick example, so we've got equipment that's valued at $150,000, and this is a little atypical, because I know in farming, if something's worth $150,000, you probably bought it 10 years ago for $100,000, because the farm equipment keeps going up in values. But in this case, we've taken a value of $150,000. You had bought it years ago at $200,000, taken $125,000 in depreciation. So we have a remaining cost basis of $75,000. So we're selling it for $150, has a remaining cost basis of $75. So the gain is $75,000. However, you've taken $125,000 of depreciation, so that full $75,000 gets taxed at the 25% rate for recapturing depreciation. Not something we want to look forward to. So we need to be careful in farm sales how we allocate the sale and how we do our supporting valuations. Generally, the farm residence can be excluded. There's certain rules there. It has to be your personal residence for 2 out of the last 5 years, but can generally be excluded from the computation of taxable gain on the sale. A number of years ago, they changed the rule on the sale of homes, so your home and the area that would be surrounding your home is exempt from tax unless you've got more than $500,000 of gain on that. So we allocate the purchase price or selling price between the residence and the property around the house, the farm buildings, and the farmland. And that's very important to do and very critical as to how we do that, particularly if there's some equipment involved in either equipment that's in the farm buildings or equipment that's also going along with the sale. Any gain from that sale is reported as capital gain for federal and state purposes, and our best estimate of tax on that gain now that we're into 2013, and Pennsylvania taxes everything, as we know, at about 3.07%, is about 18% to 26% is what you can sort of figure there for capital gain. So, rough figuring, figure 25% of the net gain after you've been able to exclude a portion for the house. Alex mentioned that the inheritance tax is 4.5%, so we can't ignore that because on a $1.5 million farm, that comes to $67,500, which has to be paid in cash. So, any questions to this point? So I'd like to go into a couple examples that I've worked with. Let's see, this first one, these folks came to me in December, and I know all three generations. Grandmother and grandfather have owned their farm for 50 years. He was an active dairy farmer. He's now probably 8 years old. His son and daughter-in-law were also dairy people, farmed, but I guess the politest term to say was that they were unable to farm effectively. They paid a very minimal rent, didn't keep the buildings up the way grandfather would have liked, and so grandfather did not sell to his son. However, his grandson wanted the opportunity to purchase, and they decided to pass it along to their grandson using a technique that Alex had mentioned, where it is a partial gift, partial sale. I think I said the farm was $1.5 million. It's in a fairly valuable area, but all the grandson could afford to pay was $500,000. Till he worked the numbers out, he felt comfortable being able to pay the $500,000. Grandparents took no money down. They got an appraisal for the farm. They have to file a gift tax return between $1.5 million that they're going to be, that is the fair market value, and the $500,000 that the farm is going to be sold at. So they've made that $1 million gift. All that's going to do is well, first of all, it reduces their estate because their farm's no longer there. If they live for a year, there will be no clawback on the Pennsylvania inheritance tax. Income tax purposes, they report the gain from the sale on the installment as the money is received. So they've got $500,000 coming to them, which they believe will assist them in the future for their retirement years, and they'll pay tax on the capital gain as it's received. This farm had also been they'd also gotten an ag easement and finished a 10-year payoff on that about a year ago. But the farm was still worth $1.5 million. And tax will be paid on the interest received from the grandson. And I think on the next page I have highlighted the grandson's position. Yes. For depreciation purposes, he gets the price that he's paid, the $500,000. That was in excess of the grandparents' basis. So he can depreciate starting at the $500,000, allocating that between land and buildings. Could they have gotten a better result? Maybe, but that would have required, this is, I think, falls back on not only what Alex was saying, but also what Darlene had mentioned at the beginning, that we don't want to let the tax tail wag the dog. Had the grandparents kept that farm until they passed away and given grandson the option to buy it through their wills for $500,000, that would have been perhaps a better result because grandson would have then been able to step up to the $1.5 million value coming through their estates. However, we would have had the $67,500 of Pennsylvania inheritance tax, assuming the farm didn't grow in value beyond that $1.5 million. So we had the inheritance tax. And we had other family issues. We would have had other family issues at that time. Who's this one grandson out of all their grandchildren? Why is he receiving this $1.5 million farm for $500,000? You know, maybe there's somebody else that is married to somebody who would have preferred to buy that. So all that's avoided. The grandparents are taking that heat during their lifetimes. Okay, now bear with me on this one because this ends up with a 3-for-2 sort of, or a 2-for-3 sort of, depending how you look at it. So we've got parents who are age 60. They have 3 sons. Oh, I'm sorry, not this one. That's the next one that's going to get really tricky. This one is parents are age 60, have 3 sons. This is they have a farming and hog operation, and The parents, I remember transferring the farm to the parents from the grandfather when this son was 35 years old. Got it as a bargain sale. The purpose there was to let him start to build equity. He paid his father on the installment basis for 25 years, and grandfather passed away about 4 or 5 years ago. So they have 3 sons. 2 are active in farming and would like to take over the farm. And each of those 2 have been working on their own, doing some custom work, acquiring some equipment, renting land, and working with their dad. The third son works in a farm-related business. They've spoken with the 3 boys. If the parents had had sufficient cash reserves, they would have given the farm to the 2 sons and have those 2 pay an installment to the 3rd son so that he gets his value today rather than the parents are only 60. I can say that now. They're only 60. So when they pass away many, many years in the future, we all hope, who knows what the farm value might be. But they don't have sufficient cash for retirement. They just haven't been able to put money back for retirement because of through their farming operation. So the solution that we developed was that father and each of these 2 active sons made a list of their equity in their equipment. And I was telling somebody at lunch that I was really surprised over he was 35 when he got it, he's 60 now. Over that 25 years, how much equity Dad had built up in equipment. Because he never really had a lot of profit on the farm. But when you value the equipment at today's reasonable values, it came to something like $250,000. So it was more than the boys were going to be able to write a check for sure. And each of the boys, particularly the older son, who's now probably 32, has developed a good bit of equity in his equipment as well. The 3rd son's coming along behind. He doesn't have much equity yet, but he's very aggressive. So father's going to so we had the 2 sons form a limited liability company to conduct their farming operation. One of my preferences for using the limited liability company is when there's custom work involved and you've got your trucks and equipment out on the road and you got people that don't know how to drive on the road when farm vehicles are there, that we wanted the liability protection. Father's going to be receiving rent from the farming operation as a return on his equity. So he'll be getting something for his equipment as the equipment is used up. He may also receive wages because he's still actively involved. And the LLC is going to rent the farm from the parents until these 2 boys are in a position to start to buy the farm. So we've got to get the equipment taken care of first. We're hoping that's going to take about 5 years. And that at that point they should have the equipment, should have more equity in their equipment, and have gradually replaced their dad's equity with their own. At that point, they should be able to either continue to rent the farm from the father, depending on circumstances at that time, or begin an installment sale, probably at less than fair market value, with the proceeds of that sale providing the parents the retirement income, and the 3rd son will be equalized when the farm is transferred to the other 2. And that can be with either a lump sum, purchase is financed, or an installment obligation. So that one's a challenge because there's not enough money to go around at the present time. But it's not a unique challenge because that's often what we run into in our plan. Just check and see how long it's supposed to go. I'm supposed to be done now. But I really like this one. This one's the really neat one. Okay. Parents own 2 farms. They have 3 sons who are ready to take over the farms. They actually have 7 sons, but they took care of the other 4 earlier. Farm is surrounded. The farm number 1. This farm is surrounded by development. This one's down in Chester County. There's a Walmart about half a mile from the farm. Before the family had purchased that farm, the previous owner had sold off all the road frontage. You know how that works, so that the farm's sort of stuck there in the middle. But believe it or not, so the farm has a high fair market value, low basis for depreciation. But believe it or not, that farm was subject to ag preservation right in the middle of all that development. Chester County. I can't explain it. So father finds another farm to purchase for a third son, not the one on this farm. He orchestrates a 1031 exchange where he sells this farm number 1 to the son that's in the middle of the development for $300,000. It's a very small dairy farm, and quite frankly, that's all it can afford in the debt service. Plus the amount recoverable by placing the farm into ag preservation. Now, in this situation, they applied for ag preservation. They had to wait a year or two for the money, so the sale was done so that the farm was sold for $300,000 plus the ag preservation money to come. That was an additional $300,000, so he sold for $600,000. Purchasing son restarts his depreciation at the $600,000 that he paid for it, providing him future depreciation, and that's going to help him amortize this $300,000 in debt that he owes to that outside party. Now, we don't stop there, because father took that $300,000 that son 1 paid and the $300,000 that ag preservation paid son 1 to pay dad. He purchases another farm for his third son. Now, this is just land. There's no buildings on that. So dad's basis in this farm is low because of the 1031 exchange, but he then borrowed funds and built new dairy buildings on that farm for his third son. Son 3 rents the farm for 2 years until he's on his feet owning his cattle. And he sells that farm to his son for a discounted price based upon son's ability to service the debt. Father takes those proceeds and retires all the debt that he had to build the buildings. Father had a loss in the sale of that farm.
I'm going to be doing the next presentation, but before I get started, a disclaimer. Actually, another gentleman from my office was going to be doing the presentation, and he's a very dedicated employee. He's so dedicated that he had an ordinary event just to emphasize that things can happen to people. But Lenny Kaplan, who's been with us for many years, who is our benefits manager, very good. He would have done a great job, but he had what I call a nice big warning. And so he's not able to do the presentation. So I'm filling in, so you'll be stuck with me. But I have his apprentice here, Mr. Topher Delpino. And Topher's been with us for about 9 months now. Not quite ready for prime time, but he's on the right track. Topher graduated from University of Pittsburgh. He's actually actuary. Topher is going to do an exceptionally good job for us, but he's not ready yet. But he will answer questions if we have some questions later on. So I'm going to talk about some life insurance products and strategies to kind of deal with some of the issues that were brought up earlier. And look at that. You can even handle these now. But what we want to do here is give you some knowledge so that you can make some good, informed decisions. Because there's lots of options that you may have, not just with the legal and the accounting aspect of things, but also maybe how you can fund some of these things that you can thought of. And so there's some solutions. And whatever we do, the goal is that you have some peace of mind of knowing that your assets are protected in some fashion, whether it's by the way you have things structured or that you have some products to help take care of that. Now, Ron and Alex discussed lots of issues as far as taxes and legal issues, and most of those had some financial consequences that are involved with them. And so their money needs to be paid out. So you need to go about that by perhaps if you have the cash, if the family has the cash to pay them, I mean, that's certainly an option. Or you could see John or Ruth, and there's banks who will lend money, and that's certainly an option. But another option may be life insurance, and I'm going to talk about two types of life insurance policies because you may want to make a small investment and transfer some of that risk to an insurance company. And the first type of policy I'll talk about is survivorship life. And basically it's one policy that covers two people, usually husband and wife. And the way that it works is it pays after the second person dies. But, and its intended purpose is to pay for the taxes and final expenses. And the reason this might be a good option for people is because the underwriting that they do for this is on the healthier person. And we're talking about that later on. So you have a husband and wife, and one of them may have some medical issues. It's a way in which you can get a life insurance product at a more reasonable cost because they're going to underwrite it and price it on the health issues or the health of the healthiest person. So that is that particular policy called survivorship life. I have 10 seconds. And the other type is a key, typically called a key man, key person life policy. Where in a business relationship, so whether it's an LLC or you have a family business, you need to have an agreement between the two parties as to who's going to buy what, and it would be advisable to have predetermined prices and methods. So you would have to have a formal agreement, and it has to kind of indicate in there what the terms are. But then one of the most practical ways to fund that agreement is with the life insurance policy. So in the event that one person dies, there's monies to pay those obligations of that agreement. So that's a key person life policy. And usually, and what's important, we'll talk about this in more detail, is the way the policy is structured as to who is the owner, who is the premium payer, and who is the beneficiary, so that the intended purpose of that policy can come out the way it's supposed to. So those were two life products for the event that someone dies and to take care of those expenses that are associated with transfer of that asset to the next party. But the next several policies I want to talk about are policies involve persons living because there are chances of things happening to people while they're living affecting their ability to actually have to transfer or to continue the lifestyle that they were, are actually pretty great. So we're going to talk about 3 types of policies: disability insurance, critical illness, and the long-term care. Now, disability insurance, basically, it protects a person's ability to earn money. So if something happens to someone, whether they are injured or get an illness and they can't work, is to pay for their loss of income. And generally, it's based on a person's income, their documented income. But there are some companies that will have a specific policy for farmers, because farmers' incomes are not as predictable as many other types of businesses. So there are some companies with very specific policies for farmers. It's based on acreage or number of head of cattle, and there's the amount that you can get. So there are policies that are specifically set up for farmers. But there's a kind of an impressive statistic that it's like there's a 42% chance of a person having a disability is greater than having a premature death. So this is something that actually can be a very important part of one's plan in perpetual business. The other is a critical illness policy, and this policy is written where basically you buy a lump sum of cash, and it's triggered by something terrible happening to you. So it's either you have a heart attack or a stroke or cancer or something like that. And when that happens, the lump sum of cash that you purchased instantly becomes yours. Because while you're living, and the intended purpose of that is that you have monies to take care of unknown expenses. So you can go in from $5,000 to $50,000. And so if you're diagnosed with cancer, all of a sudden you have monies that you have to go to doctors or have special treatment, or ultimately you have that money to use however you want. So whether it's for transportation, overnight stays, because you don't have any income, and the underwriting of that is not as severe, and that's generally speaking, not that cost of the policy. So it's called critical illness. It's kind of an important thing to happen if you don't have disability income. For a small amount of cash, you can buy this lump sum, and I think once it's written, right? And it's even triggered so that, say you have a heart attack, you get a lump sum, 3 years, and you continue paying the premiums, 3 years later, you're diagnosed with cancer, you get that same lump sum again. So it's a kind of a neat concept, and it's something that perhaps is probably not solely. It's called a critical illness policy. And the last one, I could kind of talk about this a lot, because I lived this with experience with my father. He did not do any planning, so things were distributed not fairly or equally, but nevertheless he had needs. And so I was his guardian for 17 years through his assisted living and then consequently nursing home until he died. But the long-term care insurance pays, basically you need to buy this while you're relatively unhealthy, and it pays for those expenses associated with one's long-term care. Now, they're all written today that they cover in-home, which is where most people want to spend their time. So if so when he's in-home care, it's paid, or they have to go to assisted living, that's the next level, or if finally they have to go to nursing home, that's the take that as well. There are 6 basic life functions. Remember that, Cobra? It's like being able to eat yourself, get rest. There's 6 basic life functions. And if you lose 2 of those functions, it triggers coverage. And what you do in essence is you buy a bucket of money now for later on. And and there's different time limits that you can buy it for, and different monthly amounts that you can buy. But from my experience, my dad owned a farm, hard-working man, 44 years at the canning factory. Didn't have a lot of money, he had a lot of stuff, which we sold, and then we used that to fund his needs. And if it had not been for Social Security, Medicare, and then consequently Medicaid, I'm not sure what we'd have done because he ran the whole gamut. But we did actually pretty good with him all the way through the assisted living phase. But that was running about $1,650 a month. So between the Social Security and his pension from Charles G. Summers Cannery in Freedom of $22.60 a month, and $120, and made that last for 17 years. So he got pneumonia, and then had to go into a nursing home. That went from $1,600 a month over $7,000. It take me long to do the math. That wasn't going to last too long. So basically, we went through all of that. And his needs were taken care of, which was fine. But all those things that he worked for his whole life, they were gone. And so this is the one that can certainly affect one's retirement. And it can drain your assets quickly. Yes, Julie?
Jeff, this long-term care insurance, you can even get it as a young person, because I know of a coworker that was in she had a stroke and then other medical problems happened after that. And she was in a nursing home, and I wondered how that was paid for.
Yeah, well, that's an excellent question, because the ideal time to buy this is when one's in their mid-50s, early 60s, and in relatively good health. Now, I want to talk about this a little bit. And the key to most of these policies, get them when they're young, healthy, because they're underwritten, and if you have some serious issues going on, you may not get it, or if you do get it, it'll be upgraded, and if you wait till you're older, it gets really expensive. It's actuarially underwritten. So, but in that particular case, it may be advisable for someone to get it when they're younger. There's no age limit as far as, buying it in 40 if you want. You just have to pay the premium.
Because you only think of being older than your 40s that you need it, but something like that can happen to younger people as well.
Oh, exactly. So, so it probably is advisable even at a much younger age. And of course, the younger that you buy that, the less that cost is. And I'll give you testimony about rising insurance premiums when you're older in a minute. But anyway, the long-term care is a very, very important product that more and more people really should consider, because they can really just wipe out mistakes. So all these things we're talking about here may be fine, good, but you're looking at probably over $8,000 to $9,000 a month now in a nursing home. That can is really good money. And if you are unfortunate and either have a stroke, perhaps even in a serious accident, and have to be in some sort of assisted living, you have a younger person, those expenses go up. And there are government programs to fund that, but it's after certain assets have been depleted before they're actually kick in. Any other questions? Very good. Thank you, Julie. She gets the prize.
Jeff told me he paid $20 per person.
Now, some considerations that you may face when you transfer property. The first one, and I had mentioned, is keep costs down by getting plans when you're young and healthy. Life insurance, disability insurance, they're all rated based on your age and your health condition. And hopefully you've experienced this already. Young people with health issues, or diabetes, things like that. So somebody, thinking that maybe in their 30s they're going to go get a policy for a lot of money. They have diabetes. There's all sorts of issues. Many of it has been outright declined. So that's the first thing, the age and the health. And personal testimonial, one of our insurance companies used to to have life contests, sell life insurance. We're never really good at that. So Joy and I bought life policies for a lot of years, help make numbers. And they were term policies. So, they were like $270, $80. And then they expired. And we get the renewal. They're like $3,000 because we're 15 years older. It's crazy, So I'm on you. Get this stuff while we're young and healthy. The other important thing is to work with a professional who is a professional, and this is the primary thing that they do, and has access to markets so they can structure the plan that's proper for you. So there are all sorts of insurance agents out there. It's like property and casualty, what we do. We've aligned ourselves with certain insurance companies that specialize in farm insurance because that's what's important to us, and they do a good job. And so it's important to have a company that understands what you're doing. And the same as you need to have an agent who understands that type of business too. So you can have, I'm not being disrespectful to a state farm or nationwide, but if you're going to get into an estate plan and you need to have insurances and you have a key person, and that policy has to be structured properly because it's very important. So who owns the policy, who pays the premium, and who's the beneficiary. And if it's not structured properly, you may have an insurance policy, but it may not get the benefits might be there, but it could be taxed for or not. So it's very important to have those policies structured properly.
Hey, Jeff.
Yes.
Some of these plans that I'm familiar with, there's a fair amount of options that are available to people. And you have to be familiar, and that's why it's important to deal with professionals that they know what they're doing so that they can structure that plan according to the options that are available.
Yeah, that's exactly right. And even to know that. And the other thing too, as with the P&C business, there are companies that very specialized in the life, the disability, and the long-term care products. For example, we do sell the long-term care, but we don't actually sell it. We deal with a person, Bob Preston. All he does is he's an expert at it. He has all the markets. He makes sure the finds you down. He does the absolute best thing for the customer. We could probably do it. We're licensed to do it. We may not. Maybe it's not intentional. We may not do the best thing for the person. So we've aligned ourselves with somebody who does long-term care. We're very comfortable with that. It costs a little bit. It's well worth it. Same with like that company I mentioned that does farm disability. I think companies like farm disability, maybe 1, 2, so you have to have access to that. So that's another reason to be dealing with somebody who's has access to these markets, and that's basically why we at Keller-Brown have Ronald Kaplan, when we get back on the tow firm. That's all they do. They don't sell anything else. That's all they work with. So there we go. Any other questions? They have the answer. Okay. Very good. We're going to wrap this up with Sarah Brown, who's going to talk about the importance of properly aligning legal entity and policy names. And if I make look for a little bit, I'll talk about Sarah Brown. She is a commercial insurance protection analyst and marketing manager at Keller-Brown. She's been fifth generation in the firm with 8 years of experience and responsible for designing insurance protection plans for farms, businesses, and individuals. Sarah received a full athletic scholarship while playing volleyball at King University in Pittsburgh. And while she earned her BA in concentration in leadership and change management in business, she was a commercial underwriter for a national company and also control coordinator. And for her 3 years of company experience, she was right along. She's what she does now. And in 2007, she earned her CRM designation and her CIC in 2007. There's her lifetime. Big deal. So anyway, Sarah is on the leadership training program with Leadership York. She's a board member of the Farms and Natural Lands Trust of York County, and she's also active with the Susquehanna Alumni Association. And this is her Facebook. Technical. All right, and so Sarah, you come up and wrap this thing up.
See how technical I am if I can get out of here. Great. Okay. All right, so we talked to you today about general considerations when you're transitioning a farm. Setting up legal entities, tax implications, financing a change, and then Jeff talked about financial tools, using insurance as a financial tool to protect yourself in case of death, disability, or critical illness. I'm going to talk about, once all that stuff is done, what you need to do to your insurance policy once those changes happen. So if you remember nothing else from today, just remember to contact your agent when a change happens. Very simple. Just give us a call. The second takeaway is that insurance is complicated. It's not Flo on TV or the Geico Wizard saying buy it for cheap. It is very complex, and farm insurance has its own niche. All insurance companies have different requirements. We have underwriters from our 3 farm companies here today. They all have their own requirements. So it's our job to know your situation, to know their guidelines, and then put together a policy that's going to make everybody happy. So this presentation will address considerations on a broad level, but your specific situation may be different. The third takeaway for today is that the purpose of insurance is asset protection. An asset is land, real estate, livestock, equipment, and any other stuff that you own. And that can be taken away by a claim, such as fire, wind, a lawsuit, or many other types of claims. So we want to structure your insurance policy with coverages that are going to protect those assets. And it does that in 2 ways on an insurance policy. It does that through liability and through property. So first I want to talk about liability. If you don't know what liability is, just think, whoops. It's when you unintentionally cause injury to somebody or damage their property, and now you're responsible to pay for their loss. So that's liability. Farm liability insurance provides coverage for farm-related operations. And for those individually named on the policy, it's going to provide personal liability coverage. So that's liability coverage for you when you're off the farm, when you're away from the farm. Now, liability is used when you become legally obligated to pay a third party for a claim. And legally obligated is a key term. It's not because you want to pay them, it's because you have to. It also pays attorney's costs, and it pays for judgments made against you. What it does not pay for is injuries to yourself or damage to your property. Property insurance pays for damages to your own property. So that's a house, building, equipment, livestock. If you think of liability as whoops, think of liability or property as stuff. Now, an insurance policy is actually a contract. It's a contract between owners of land and operation and the insurance company. And when you change that ownership situation, we need to change that contract to make sure everything is protected. So again, remember the first takeaway, contact your agent. Now, who gets covered on an insurance policy? There's 3 levels of coverage. You have a named insured, an insured, and an additional insured. First, we'll talk about the named insured. Who can be a named insured? Well, it's any person or entity that has ownership of an asset. That can be a sole proprietor, an individual like a husband and a wife. It can be a partnership, a limited liability company, a corporation. Named insured can also be an estate or a trust. Now, the rights of the named insured are also very specific. The named insured is the only person that can make a change to the policy. The named insured is the only person that's going to receive a claims check or a premium refund. And they're also the only person that can cancel the policy. And can you have more than one named insured? Yes, you can, as long as there is common ownership. So you can have an individual that owns land and real estate, and that can be a husband and wife. And and then you can have an LLC that owns the farming operations. So you can have both as a named insured as long as one of the individuals is a member of the LLC. So we talked about the named insured. Now, who is an insured? Well, a named insured is always going to be an insured. Other insureds will be members of your household as long as they're a resident relative. That can be your kids, they live with you, your parents. Any employees you have are going to be an insured on the policy, and full-time students away at school as long as they were a member of your house before they left. Also, who can be an insured is going to be a partnership, an LLC, or corporation. As long as and the members of the partnership and their spouses can be an insured, but only with respect to the conduct of your farming operations. That's the only time they'll have coverage on your policy. The same thing is going to be true with an LLC or corporation. Members of the LLC will have coverage on your policy, but only with respect to farm operations. Now, an insured can receive the coverage benefits of the policy, but they also have restrictions. They can't make a change. So your kids can't call and make a change to your policy. They're not going to receive a claims check or any premium refund, and they don't have any ownership of property. So we talked about the named insured and then the insured, and now there is an additional insured. So what does that do? An additional insured gives liability or property damage coverage for specific types of ownership. Property damage coverage is restricted to ownership interests, and restrictions can be for certain locations, for certain equipment, or a specific entity. The additional insured name will appear on a claims check, but only with respect to their ownership in specific property. Where we see this is with banks. If they loan money for equipment, they're going to see their name on your policy for that piece of equipment. Or if you're farming somebody else's land, they may want to see themselves as an additional insured for liability. So let's compare and contrast. Very simply, the named insured has all the power and the protection of the insurance policy. An insured has protection but no power. They can't do any changes. And an insured is just a definition built into that insurance contract. You can't change it. An additional insured has protection but for specific property and operations. And they have to be added to your policy by the named insured. And in the fold on the right-hand side of your folders, I have highlighted where on your policy you can see named insured, where you can see an additional insured, and then all the definitions of an insured. So it's really, really important. The name of the owner of land and equipment must be listed on the policy somewhere, either as a named insured or an additional insured, depending on the relationship. And if they're not listed, there is no coverage. So think about if you just set up a new entity for this farm transition, spend a lot of time with your accountant and your attorney, but you don't call to update your policy, there's no coverage for that new entity that you just set up. So that's very important. Yes?
Sarah, we had a situation the other week where we have a very large grape farm. They also sell produce and so forth. And the insured had called to say it was a partnership between father and son. And they had fallen out. And so in the midst of the agent trying to separate everything, the agent realized that there was another entity that was taking over the produce, that was in place for the produce operation. So if they had a claim, we didn't have them listed as an additional insured or as a named insured, they wouldn't have coverage.
They wouldn't have coverage on that policy.
Because they had not contacted the agent to tell them they had formed that other entity.
Yeah, so spend a lot of time and thought if you want to get those other entities set up, and that's great. But if that policy doesn't reflect coverage, that's when you pay it out of your own pocket. Thank you. So I just gave you some terms, and I felt I needed to do that to serve as a basis. I have 3 case studies for you that hopefully put everything together. So the first situation, we have a named insured, we have a younger resident relative, and equipment. So PAP owns the farm and all of the equipment. PAP is going to be a named insured on the policy. Junior lives with PAP in the house, and he works on the farm. So Junior is an insured on that policy because he's a resident relative. Junior would like to one day own the farm, but in the meantime, he starts buying equipment in his own name. So now we have a situation, we have Pat that doesn't own that piece of equipment, Junior does, but Junior doesn't own the farm. How are we going to make sure that if that piece of equipment is damaged, Junior's going to have protection? We can't write a policy just for Junior, just for that piece of equipment. Junior's, again, an insured on that policy for liability because he's a resident relative. As long as he's living with Pat, he's got coverage on his policy. Then we have to add that piece of equipment to make sure it's accounted for, but then we list Junior as an additional insured for the property for that piece of equipment. That's going to make sure that Junior's name is going to appear on a claims check that the equipment is damaged or totaled. The next case study we have is a farming operation that's controlled by an LLC. The LLC owns land and equipment. The members of the LLC are Mom and Dad. Mom and Dad live at the house. Sonny and his wife live a mile away in a house that they own personally. So everything's fine, but now Sonny becomes a member of that LLC. We have a couple situations. How do we cover Mom and Dad? How do we cover Sonny and his family? And where does the LLC fit in? Since Mom and Dad live at the farm, they're going to be listed as a named insured. Doing that gives them personal liability, and it also gives them coverage for their house and their contents in the house. The LLC needs to be listed as an additional insured for property and an additional insured for liability. Now, the members of the LLC are protected for their interest in the farm. But what about Sonny? There's two ways we can handle Sonny. First is we write a homeowner's policy for him. That's going to give him personal liability coverage. He has coverage for his house and contents. And Sonny's provided coverage on the farm policy for his operations as they relate to the farm because he's a member of the LLC. The other thing we could do is add Sonny and his wife as a named insured onto Mom and Dad's policy. Doing that acts as a homeowner's policy for Sonny. He has coverage for his house. We list the house and his contents, and he has personal liability coverage. And we can only do this if Sonny has an ownership interest in the LLC. So which option should we pick? It really depends. But one thing you want to keep in mind, if you list Sonny and his wife as a named insured on Mom and Dad's policy, you now have 4 named insureds. That's 4 people that can make a change to the policy, 4 people whose names are going to be on the claims check, and 4 people that can cancel the policy. So that relationship has to be very clear and defined, and it has to be, you have to be comfortable with doing that. Premium is going to be another consideration. There's going to be a difference between a homeowner's and a farm, but it just depends. Now this third example I'm going to give you is a lot more complex. I'll mention some things that I haven't talked about before. Don't get hung up in the details. What I'm trying to highlight is how things change and how you need to remember to contact your agent. So we have George and Arlene Kramer. They bought their first farm in 1970 and they called it G&A Farms. They have 2 children, Bill and Maureen. And in those early years, they raised sheep, they grow soybeans and vegetables. So the named insured is going to be listed as George Kramer, Arlene Kramer, and G&A Farms. Now, G&A Farms is a fictitious name, but the farm is operating under there, so we want to put it on the policy so it has coverage. And then Bill and Maureen, the children, are automatically covered on the policy as insureds because they're children, resident relatives. Okay, time moves on. George and Arlene expand their operation. They buy more farms plus lease land. As the children grow, more emphasis is put on the soybean operation, and George switches from raising sheep to raising cattle on a large scale. So we need to make some changes here. We have to add the additional land as farm locations on the policy, and then certainly they're going to have more property when they buy more farms, so we have to list those additional assets, building, equipment, whatever. Now, Bill goes on to college and earns an ag degree. He comes back to the farm and becomes part of management and decision-making. And in 2005, G&A Farms is incorporated. So now we have another big change. We have to add G&A Farms name to the policy, so that operation has coverage. So we're going to do that as an additional insured for liability. And then for any property that G&A Farms Inc. owns, we add them as an additional insured for property. Now, assuming Bill's a shareholder or an executive officer, he's going to be covered as an insured on the policy, but only with respect to the farming operations. Now, in 2010, Kramer Family Farms LP is formed to purchase more land. So now we have another entity. We want coverage for that entity. It has to be reflected on the policy. So we add Kramer Family Farms LP as an additional insured for liability for its ownership of land. Now, given the demand for beef, in 2011, George built a brand new 300-head beef farm using cutting-edge methods and technology. With the help of Buy Fresh, Buy Local initiatives, his customer base grows. His beef is marketed locally as grass-fed, custom freezer beef. He ships to various markets. G&A Farms, Inc. was featured as a beef supplier on the menu at Juliana's in the Village, our caterer. So there are definitely some changes we need to make. George has a considerable asset in this new beef farm. If we want coverage for it, we have to add it to the policy. Wholesale beef sales are covered under the farm policy for liability, but we need to add a business activities endorsement for retail sales to the public. Now today, G&A Farms Inc. has 3 full-time and 2 part-time employees. They farm approximately 2,500 owned and rented acres. More changes. Okay, we need to have the farm land owned and rented as location for liability coverage. Now, the employees will be considered insured on the policy for liability, but that's not going to cover their injuries. So they need a workers' compensation policy for the employees. Okay, so in summary, contact your agent when you have changes. Number 2, insurance is complicated. I tried to make it simple, but if I fail at that, then I prove that insurance can be complicated. The purpose of insurance is asset protection. Farmers have lots of assets, and if you can't pay your own cash to rebuild them, you can pay the premium for an insurance policy. Number 4, remember the difference between a named insured, who has power and protection, and insured, who has only protection, and an additional insured who has protection for specific ownership. And finally, time changes things, so stay in touch with your agent. That concludes today's seminar. I'll gladly take any questions, and we can also bring the speakers up here for any general questions. Yes, Dave?
You know, one thing to think about, too, is as time changes on the farm, more and more different methods are trying to be, they're trying to come up with agri-tainment to squeeze more money out of a very minimal operation. And it's better to make the call to your agent and say, hey, I'm thinking about this, as opposed to, hey, guess what I did yesterday? And
then having somebody say, I'm sorry.
And then
not covered.
Right.
Yes.
Comment on the time changes things. We see a lot of customers that don't visit with their agent on a regular basis, and then they're looking 20, 30 years down the road. Insurance products change just like cars change. You're not going to be driving around in a 1985 Celebrity and expect to have some of the features you have today, but the same thing with insurance. So make sure you just visit with your agent, check your coverages. Make sure you have some of the things that we offer today on your policy. That way, if something does happen, because you only know you don't have coverage for it until